Imagine losing $5.65 million in 6 months. Are all your eggs in one basket? Do you have too much in one stock? So watch on to learn strategies for concentrated stock options. I was having a conversation with someone I'll call Robert, and he was asking me if my company can help him with his situation. You see, he had over $7 million worth of his company stock that decreased to $1.35 million, a loss of over $5.6 million in a matter of 6 months, which gives him no clarity where to go from here, if his stock is going to go down further or not. So we all know recovery stuff. Market losses have more impact than gains. So we agreed to help him and salvage what he has. But it may not be too late for you. I created this video so it could help you get some clarity about some of the options that are available to you. If you're like many of our clients that sold a private business, earned their stock through their work at their company, they might have inherited some large holdings, exercised options to buy their company stock. Some of them held restricted stock or have benefited from repeated stock splits over the years. In our opinion, as a firm, having a large position in a single stock carries unique challenges, rewards, and dangers. Even if the stock has done well, many may want to protect their gains against losses that could set them back, sometimes permanently. So what we will try and help you with today is potentially create a shift in your strategy that could save you from unexpected losses. You see, it is always easy to cure a problem before it takes hold, but once it sets in, it really can be hard to fix sometimes. So one important thing to keep in mind is that dealing with concentrated stock strategies must be taken with the utmost care and consideration. Make sure you consult with a team of financial advisors, attorneys, and accountants. And if you feel that some of the strategies are beyond your expertise, then ask for professional help. We can always give you guidance if you need it. We have assembled a team of licensed professionals and experts that can help you with your questions and possible implementation. Always remember, you must have what we call at Confidence Wealth interconnectivity balance, where the strategy is carefully measured and crafted against the entire spectrum of your optimal financial world. So first things first, time counts when dealing with large stock holdings. We always look at your time frame. Some strategies such as hedging might be most suitable in the short term or if you're restricted from selling. Others such as donating to a trust may be more cost effective over a longer time period, though your charitable intentions obviously play a role as well. So you must be aware that managing a concentrated stock position is a complex task that may involve investments, tax, and legal issues. It is highly advisable that you work with a professional that understands complex strategies and is familiar with the strategy of interconnectivity balance, who can help you navigate that particular maze. And there are no guarantees that working with any financial professional will improve investment results. So let's talk about the first strategy, and it's the easiest one. Sell your shares. So selling obviously frees up the funds that can be used to diversify a portfolio. However, if you have low cost bases, you may be concerned about capital gains taxes, or you may want to avoid any perception of market manipulation or insider trading. You might consider selling shares over time, which can help you manage the tax bite in any one particular year, yet also will allow you to participate in any future growth. You'll need to consider the tax consequences of any sale. Long-term capital gains are generally taxed at a special capital gains tax rate of 0%, 15%, and 20%, depending on your taxable income. By contrast, because short-term capital gains are taxed as ordinary income, the top short-term capital gains tax rate can be 37%. Higher income taxpayers should be aware also that they may be subject to an additional 3.8% Medicare unearned income tax on net investment income if their adjusted gross income exceeds $200,000 for single filers and $250,000 for married joint filers. If you hold restricted shares, you might set up a 10b5-1 plan, which spells out predetermined schedule for selling shares over time. That kind of written plan specify in advance the dates, prices, and amounts of each sale, and comply with Securities and Exchange Commission Rule 144, which governs the sale of restricted stocks and was designed to prevent insider trading. So a 10b5-1 plan demonstrates that your selling decisions were made prior to you having any insider knowledge that could influence a specific transaction. However, terminating the plan early or selling too much too quickly could raise questions about the plan's legitimacy. You might also be able to avoid some of the restrictions on how much and when you can sell by selling shares privately rather than on the public market. However, you would likely have to sell at less than the market value and could still face capital gains taxes. Let's talk about strategy number 2. Hedge your position. You may want to help protect yourself in the short term against the risk of a substantial drop in prices. This gets very interesting, but you have to be careful because the strategies can be complex and you will sometimes need experienced guidance. There are multiple ways to try and manage that risk. One of them is by using options. However, keep in mind that the use of options is not appropriate for all investors. For example, buying a protective put essentially puts a floor under the value of your shares by giving you the right to sell your shares at a predetermined price. Buying put options that can be exercised at a price below your stock current market value can help limit potential losses on the underlying equity while allowing you to continue to participate in any potential appreciation. However, you would also lose money on the option itself if the stock price remains above the put strike price. You may consider selling covered calls with a strike price above the market price to provide additional income from your holdings that could help offset potential losses if the stock price drops. However, keep in mind that calls limit the extent in which you can benefit from any price appreciation. And if the share price reaches the call strike price, you have to be prepared to meet that call. Now let's get into some more complex option hedging strategies, such as putting a collar around your stock position. A collar involves buying a protective put and selling a call option whose premiums can offset the cost of buying the puts. However, with a covered call, the upside appreciation of your holding is then limited to the call strike price. If that price is reached before the collar's expiration date, you would lose not only the premium you paid for the put, but also face capital gains on any shares that you've sold. So be careful about closing one side of the collar while the other side of the trade remains outstanding. For example, if you exercise the put, but the shares you sell are later called away prior to the call's expiration date, you could be left with an uncovered call and you could potentially suffer a loss if you had to repurchase the shares at a higher price to fulfill the call. A note of caution here, make sure your collars are not too tight and keep in mind that transaction costs in multiple leg option strategies such as collars can be significant and should be considered as these strategies involve multiple commissions, fees, and charges. Also, the price set for the collar must not violate the rules against what's called constructive sale, which is a strategy that eliminates all risk, is effectively a sale that's subject to capital gains taxes. The strike prices of a collar should not be too close to your stock's market price. Always remember, options involve risk and are not suitable for all investors, and you may lose the entire amount of invested principal in a relatively short period of time. Prior to buying and selling an option, you must receive a copy of the characteristics and risks of standardized options. You can get copies of this document from the OCC.com. Let's talk about the third strategy, monetize the position. This strategy is what we consider for our clients when they want immediate liquidity. We would help them open a contract to sell their shares later at a minimum specified price. They receive most of the payment from those shares, typically around 80% to 90% of their value, when the agreement is signed. However, they're not obligated to turn over the shares or pay taxes on the sale until the contract maturity date, which might be years away. When that date is reached, they can decide to either settle the agreement by making a cash payment or turn over appropriate number of shares, which will vary depending on the stock's price at the time. In the meantime, the stock is held as collateral and they can use the upfront payment to buy other securities that can help diversify their portfolio. In addition, this kind of contract will allow them to benefit to some extent from any price appreciation during that time, even though there may be a cap on that amount. A word of caution, these agreements must be approached with extreme caution and care. As they're complicated, the IRS warns that care must be taken when using them, so consult with a tax professional before using this strategy. Fourth strategy, borrow to diversify. If you want to keep your stock but need money to build a more diversified portfolio, you could use your stock as collateral to buy other securities on margin. However, don't overlook that trading securities on margin account involves significant risks and you can lose more funds than you deposited in the margin account. So consider speaking with a financial professional before considering the strategy or contact us. We can conduct a margin stress test so it can help you decide if this particular strategy is right for you. Now let's talk about the fifth strategy: exchange your shares. This is an advanced strategy we have considered for many of our clients, and that is to trade some of their stock shares in an exchange fund, which is a private placement limited partnership that pools their shares with those contributed by other investors who may have concentrated stock positions. After a set period, generally 7 years, each of the exchange fund shareholders is entitled to a prorated portion of its portfolio. Taxes are postponed until they sell these shares, and they pay taxes on the difference between the value of the stock they contributed and the price received for the exchange fund shares. Even though this strategy provides no liquidity, an exchange fund may help reduce taxes while providing greater diversification. Keep in mind that diversification alone does not guarantee a profit or protect against investment losses. It is important to check on the cost involved with those exchange funds, as well as what other securities it holds. At least 20% of it must be in non-publicly traded assets or real estate, and the more overlap between the shares and those already in the fund, the less diversification a person can achieve. Now let's talk about the sixth strategy: donate shares to a trust. This is an interesting strategy we sometimes consider deploying for our clients that are charitably inclined and want income rather than growth from their stock. They transfer shares to a trust when they have highly appreciated stock. We help them consider donating it to a carefully crafted charitable remainder trust, CRT. In some instances, we find that they may also qualify for an income tax deduction on the estimated present value of the remainder interest that will eventually go to charity. Typically, the trust can sell the stock without paying capital gains taxes and reinvest the proceeds to provide an income stream for them as a donor. When the trust is terminated, the charity retains the remaining assets. Essentially, we help them set a payout rate that meets both their financial objective and their philanthropic goals. However, a very important consideration: the donation is irrevocable. Another strategy we consider sometimes for our clients is charitable lead trust, CLT, which is in many ways the mirror image of a CRT. With a typical CLT, the charity receives income stream for a specified period of time. At the end of the trust period, the remaining assets are paid to the grantor or the grantor's heirs. This can help reduce, or in some cases even eliminate, estate taxes on appreciated assets that eventually go to the grantor's heirs. One thing we keep them aware of is that there are costs associated with creating and maintaining trusts. They receive no tax deduction for transferring assets unless they name themselves as the trust owner, in which case they will pay taxes on the annual income. Other philanthropic options include donating directly to a charity or private foundation and taking a deduction. I hope this helped you understand some of the higher level strategies that can help you leverage your concentrated stock position to achieve potentially more beneficial results for you and possibly lower your risk. If you need help with your concentrated stock strategy, deployment, or making sure you achieve interconnectivity balance in your portfolio, feel free to reach out to us at Confidence Wealth by clicking on the link.